Clearwater Analytics Holdings, NYSE CWAN, is currently trading at 24.08 USD, marking a significant intraday jump of plus 1.84, 8.30% as of 1:10 p.m. ET on Monday, December 22, 2025. This surge comes on the back of massive news that has completely shifted the narrative for this fintech player. While the broader market might be looking at names like Apple stock or Nvidia stock for tech momentum, the real action today is happening right here in the niche world of institutional accounting and data. The expectation among many retail investors was that Clearwater would continue grinding through its recent acquisitions to eventually prove its worth as a public entity. The reality, however, is that the private equity world decided they weren't going to wait for the public market to catch up. A consortium led by Permira and Warburg Pincus just stepped in with an $8.4 billion cash offer to take the company private at 24.55 USD per share. This move creates an immediate curiosity loop. Why would two of the most sophisticated private equity firms on the planet want to pull Clearwater off the New York Stock Exchange right now? If you've been following the software as a service space, you know that the public markets can be notoriously impatient. Clearwater has been on a massive buying spree lately, picking up firms like Infusion, Beacon, and Bistro. On paper, these moves were brilliant for scaling their multi-tenant platform, but the stock price didn't reflect that growth. In fact, it languished while the company dealt with the friction of integration. The reality we're seeing today is that these private equity giants see a next-generation front-to-back solution that the public market was too short-sighted to value correctly. They aren't just buying a software company, they are buying a proprietary database that handles over $8 trillion in assets under management. When you look at the daily swings we're seeing today, the volume is absolutely staggering. We are talking about over 50 million shares exchanged already, which is more than 10 times the average daily volume. This isn't just retail excitement, this is institutional positioning. Even as the price hovers just below that 24.55 buyout target, the options market is telling an even more interesting story. We've seen a 469% increase in call option volume today. Some traders clearly believe there's a possibility of a higher bid during the Go Shop period, which runs until late January 2026. This is where the tension between expectation and reality gets really thick. The market expects this deal to close as is, but the aggressive options activity suggests a minority of players are betting on a bidding war or an activist intervention to squeeze out a few more dollars per share. Speaking of activists, Starboard Value recently disclosed a nearly 5% stake in the company, arguing that the integration of recent acquisitions was weighing too heavily on the valuation. When an activist like Starboard shows up, things usually start moving, and today's announcement feels like the culmination of that pressure. For those who used self-investing platforms or online investing tools to get into CWAN early, today is a massive win, but it also raises questions about the future of the fintech sector. We are seeing a trend where high-quality SaaS companies that provide mission-critical infrastructure are being plucked off the public markets because their steady recurring revenue is more highly valued by private equity than the volatile public sentiment. If you are currently managing your own individual brokerage account or perhaps using a Fidelity trading platform, you've likely noticed that the financial services software sector has been a bit of a mixed bag. While the Tesla stock enthusiasts are focused on retail delivery numbers, the back-office world where Clearwater operates is where the real plumbing of the financial system lives. Clearwater's business model is built on being the single source of truth for insurers, asset managers, and large corporations. They take messy, fragmented data from thousands of sources and consolidate it into a single, clean master record. It sounds boring until you realize that without this, Firms can't accurately report their performance or stay compliant with regulations. One of the reasons this buyout makes sense from a strategic standpoint is the shift towards alternative assets. Institutional investors are moving away from just holding plain vanilla stocks and bonds. They are diving into private equity, real estate, and complex derivatives. These assets are a nightmare to track and account for manually. Clearwater's platform, especially with the integration of its recent acquisitions, is designed to handle this complexity at scale. The company reported a revenue jump of 77% year-over-year in its latest quarter, reaching over $205 million. That is massive growth, yet the net loss of $10.5 million during the integration phase was exactly what scared away the public market and gave the private equity groups their opening. Let's talk about the competition for a second. When you look at investing sites and comparison tools, you'll see Clearwater often mentioned alongside BlackRock's Aladdin or Spate Street Alpha. These are the titans of the industry. However, Clearwater's advantage has always been its cloud-native, multi-tenant architecture. Unlike legacy systems that require constant, expensive updates and on-premise hardware, Clearwater software is updated for everyone at the same time. This creates a powerful network effect. The more data they process, the more accurate their security master becomes, which in turn makes the platform more valuable for every user. It's the same kind of platform dominance logic that makes Apple stock so resilient, but applied to the world of institutional accounting. For those using a SoFi trading platform or the Robinhood app to track these movements, the lesson here is about the valuation gap. Sometimes a company's fundamental performance, like achieving a 115% net revenue retention rate, doesn't translate to the stock price immediately. Clearwater was essentially a victim of its own ambition. By buying up competitors and expanding its footprint so rapidly, it created a complicated financial picture that required a smart friend to explain. Private equity firms like Permira act as that smart friend with billions of dollars. They see the 800-plus AI agents Clearwater is already using to reduce manual reconciliation effort by 90%, and they see a future where this company is the indispensable hub of global finance. The intraday movement today is a clear signal that the market believes this deal is solid. We are seeing the price stay remarkably steady near the offer price, which usually suggests high confidence in the closing. However, if you're holding shares, you have to weigh the current price against the time value of money. Does it make sense to hold out for the final 24.55 in a few months, or take the gains now and move into something else? Maybe look at Fidelity ETFs or Robinhood investments in other sectors. This is where investment help or a SoFi robo-advisor might offer different perspectives, but the core reality is that Clearwater's days as a public entity are likely numbered. I want to pause here for a second and get your take on this. Comment below how many shares of Clearwater Analytics you currently hold, or if you think the private equity firms are getting away with a steal at this price. Do you think more fintech companies are going to follow this take-private trend in 2026? Looking forward, the catalysts for the company will mostly happen behind the closed doors once the deal closes. The management team, led by CEO Sandeep Sahai, has been very clear that being private will allow them to invest boldly. That's code for we can spend money on R&D and integration without having to explain every penny to Wall Street analysts every 90 days. They want to build a front-to-back solution that handles everything from the moment a trade is executed to the moment it's recorded in the general ledger. If they succeed, they could become the dominant operating system for the world's $100 trillion in institutional assets. The risks, of course, are still there. The go-shop period is a double-edged sword. While it allows the company to seek a better offer, it also leaves the door open for uncertainty. If a better bid doesn't emerge, the stock will likely just pin to the current offer. If the deal were to fall through for some unforeseen regulatory reason, though that seems unlikely given the nature of the business, the stock would likely crater back to the levels it saw in November, around the $17 to $19 range. That's the reality check that every investor needs to keep in mind. The premium is high for a reason. It reflects the potential that was being ignored. When we look at the broader landscape of online investing, the Clearwater story is a reminder that value can be found in the most technical corners of the market. Whether you're using Fidelity investments, interactive brokers' fees as a benchmark for your trading, or even just managing a small portfolio on the Robinhood mobile app, the lesson here is that understanding the plumbing of the market is just as important as following the latest hype. Clearwater isn't a household name like NVIDIA stock, but the software they provide is what allows the world's largest institutional pension funds and insurance companies to function. In the final analysis, the expectation for Clearwater was that it would be a slow and steady growth story that might take years to realize its full potential. The reality is that the potential was so obvious to the pros that they decided to buy the whole company. We saw the same thing happen with other high-quality software firms over the last few years. The 47% premium over the November 10th price is a testament to how much the public market can get things wrong when it gets obsessed with short-term earnings misses rather than